Hi, welcome to Market in a Minute. Well, we have the NBA Finals coming, right? The Thunder against the Pacers. Those teams are so much alike. That's going to be a lot of fun to watch. I have no idea who's going to win that one, but it's going to be really fun, I think. The market is still good, so we want to stay with it. So the technicals are still going. The valuations are getting a little stretched, particularly in the tech area. So we think the tech stocks need to take a little bit of a time out, let the other dead cats in the market bounce a little bit. But we think that the market is still okay. We have some good buy ideas. So they're not obvious, I think, but they're really good thought out stocks that they're good for trade, but also probably pretty good for an investment as well. So the market update. So this is what bothers us a little bit. I guess we reasoned through it and came to the conclusion, okay, it's not that bad. But this is the S&P 500 bottom up 1 year earnings estimate for 2025. It starts at 280 and now we're at 264. Here's the issue. This is the start of the start of the second quarter. So this is 1st of April. The estimates for this year have come down 2.2%. So they've come down from 270 to 264. So we have to understand, why has that happened? Where's it coming from? Okay, the chart down below explains it. So we can see this is tech. The blue is where we are currently. The gray is where it was at the beginning of the quarter. And you can see if you combine tech and consumer services, now there is some also consumer discretionary stocks. I think Amazon's in there, but you have those companies that are all tech, and so Tesla as well. So you've had those. If you add all the tech names together, I think we're okay. So tech is roughly flat in terms of their estimates. Tech is really important because that's what's leading the market up, and it just needs to kind of hang out here. It just needs to just not go down, and the markets will be okay. Healthcare estimates are coming down a little bit. As you know, we like United Healthcare. We bought the big dip when the insiders all started buying it. So we like selectively the healthcare space. I think Pfizer is good to get a nice yield. Plus, we think fundamentally they're starting to turn and get better. We have low expectations for that stock, and we view it more as a yield play, but there could be some nice growth to it over time. Industrials, the estimates have come down a little bit. We think that there's a tsunami of capital spending that will coming into our country, and for multiple reasons, this is a good thing. But in particular for the industrials and also the basic industries as well will probably benefit nicely. So this is a little bit of a rounding area. There's not a whole lot going on here, but the estimates come down a little bit. Utilities, nothing going on. Utilities, financials, we like the financials. We think they're fine, and in particular the banks. Real estate, again, flat like the utilities. These estimates don't change a lot. The consumer discretionary, I wouldn't read too much into this. Obviously, this is some of the tariff impact that's going into the numbers. So I look at this more as an opportunity, particularly as those tax cuts hit in the second half of this year. And then staples, not a big change, not a lot of growth, but not a big change. And then lastly, energy. Energy stocks have been, knocked really hard. Estimates have come down. I think that this is part of the reason why the estimates for the SP have come down. But don't think that this is a big deal for the markets. So Jamie Dimon, the chairman and CEO of Citigroup, made some comments, and I actually appreciate what he said. So he basically said that there's a crack in the bond market, and that crack is our deficits. It's all the debt. So if we don't get a hold of it, that crack's going to widen and that building's going to collapse at some point. So we need to be really aware of what's going on with the debt. The federal budget deficit looks like the numbers look like they just increased so far the spending by 320 billion. So the Senate's got a lot of work to do. This gotta improve this. We can't have these big budget deficits. And granted, it doesn't incorporate all the investment spending that's going to come into the country and really boost GDP and tax revenues. But that's something. I think he's right that there is a crack in the bond market, and we just have to watch it closely. So at 4.5, we're not too concerned about the market. At 5+, then we become more concerned that we have a big problem in the overall stock market as well. Cryptocurrency. So as you know, Diamond has not been a big fan of crypto. He calls it a decentralized Ponzi scheme. I get his point, really. And then his comments over the weekend were, why are we hoarding crypto when we really should be stocking up on ammunition? It's a great point. Totally agree with it. If you look at the issues in the markets, so we think the earnings are fine. So they've come down, but they're okay. They come down in the right areas, not to be too concerned about things. The valuations are high. We're back to having somewhat of a valuation problem. We need to look out to 2026. And once we focus on 2026, the valuations issue goes down a little bit. It doesn't go away, but it goes down. It's not as big of an issue. So the valuations really become a problem if that crack in the foundation of the bond market gets any bigger. The NVIDIA reported and had a good quarter, really strong quarter actually, and the stock didn't respond very well. AppLovin and Palantir doubled in price from the bottom, and it just shows you, these stocks have ripped to the upside. It just shows you there's a valuation problem in the overall market at these sort of levels. So these are really big moves. Fundamentals are fine, but the stocks have really come back really strongly, and that concerns us about the stock market. The tech group has to hang in there. So the economy looks like it's going to grow maybe close to 5% this quarter. So you get a reverse of the trade issues this quarter. Consensus is at 1%. So that's big growth. So we're not concerned about the economy at this point. And we had the employment report on Friday, so it'll be interesting to see what comes out of the employment numbers. We think just somewhere in the 120 level will be probably about right for a new job growth this past month. Iran, we think they're running out of time. And so this is an issue for the markets in that it's going to impact oil prices, and so it'll have somewhat of an impact on inflation. So if Iran doesn't get their act together and come to an agreement that everybody's happy with, those nuclear sites are going to be taken out and oil's going to pop on it. Now, the bigger issue is Russia. So Russia really needs to come to the party and resolve the issues there. And again, Putin's being really stubborn. At one point, we think they're coming to an agreement, and then it turns around that they're not. So Russia is a problem, and it's worth watching. So we think the energy sector is worth a play here, and I'll get into that in some more detail. The technicals. So if you remember, we talked about this about a month or so ago, and we had the old death cross where the 50-day broke through the 200-day. So that's called the death cross, when the shorter-term moving averages break through the longer-term moving averages. So as we discussed, a couple months ago, that the issue with this is that it's not a good indicator. It doesn't work. It's not very reliable. It's worth noting, but about 20% of the time, it's a good indicator of a much bigger decline. So there's not much predictive value to it. Now the markets come up nicely above all the moving averages, above the 200-day. We tested that 200-day. It held it. So we're liking what we're seeing on the technicals. Now for whatever reason, it rolls over, breaks the 200-day, we're going to get very defensive very quickly. The Mag 7, the 7 largest technology stocks versus the S&P 500. You can see the huge drop in the Mag 7 when the market declined. It caught up with the S&P 500 on the downside, huge decline, and then has had a very strong rebound. So we think that, okay, we're getting to this gap again between the S&P, so everything else, and the technology sector. So this has got to work its way off a little bit. And so we're hoping that the tech stocks can go sideways for a while, or maybe modestly higher. Just hang in there and let the rest of the market kind of pop up a little bit. Let all those dead cats bounce. Okay, that's what we want to see. And as the rest of the market comes up, then we'll start to be a little bit more concerned about the technicals of the market. Hedging. So we think hedging is really important in our tactical strategies. So we're always looking for a really cheap hedge. So something that we can put on that's got really good upside potential, but we have limited downside in it. So the way our model works is we like to see 3 moving averages. Have it be above the 200-day if we're buying a stock. So this is the TWM. It's the double inverse of the Russell 2000. So as this comes down, it means the Russell 2000 has gone up. And so you can see here, this got a buy signal way back here in December. A buy signal, it went up in a huge way. This is basically 100% return from December in this inverse. Now the pullback's been pretty dramatic as well, from roughly almost $70 in the TWM all the way down to about 47, just under $47 where it broke the 200-day. Now as it comes back above the 200-day, it clicks as a buy signal, okay? All right, we like the Russell 2000 because it makes sense to us that those stocks have underperformed a lot. They're cheap. As tax cuts come around, they're probably going to start to perform better. Interest rates need to come down as well. So this is a hedge. So we have stocks that will benefit from all those trends. So this is a hedge, the way to protect those stocks or to absolutely make some money. But primarily what we do is to hedge our portfolios. And this is a nice way of doing it. Doing it with the S&P 500 right now doesn't make any sense. If it doesn't work, so we're roughly at 48 on the TWM. If it drops down below 47, 46.50, that's where we take it out as it breaks this prior low here. So again, if something happens in the markets crack, the smaller names get hit, worse than the bigger names, and this is a nice way to protect the portfolio. Now, looking for ideas. Energy stocks, okay, I mentioned this. They've underperformed by a lot. Estimates come down in a big way, and then there's geopolitical risk. So buy some high quality, that's what we're doing. We're buying some high quality companies, Halliburton. We want yield, we got British Petroleum, BP. We also like Apache, and so there's several stocks in there that we like a lot to play this. So Baker Hughes as well. That's a little bit more of a play on natural gas, which we like a lot. So you can own Baker in the portfolio. Halliburton could pop. It could go up 50% if something would happen geopolitically. BP could go up 10-20%, plus you pick off a 6% dividend yield. So there's an activist on BP, so we would own that in the portfolio as well. So you can buy these energy stocks with probably minimal downside risk, and you got some pretty good upside if something would happen. Regardless, it probably adds some diversification to the portfolio. Small caps, we mentioned this biotech stocks, small cap biotech. We mentioned this last week that we think the group's turning technically. So we don't really like the group. We rather play individual stocks that we like and know well, that we know they have 5 or 10x upside, 5 or 10x upside. And so we rather play those than by the sector. And so that's how we've outperformed over time. That's our portfolio. But there's 160 stocks, roughly out of 700, that trade below cash. So that's over 20% of the 20, it's roughly 25% of the stocks out there that trade below cash. So that's a really high number. I think we've seen as high as 200. So we're not in a bear market anymore. The bear market's come and gone, but this group has not popped. We think it will. We think the group's coming back. We think there's nice upside in the group just to normalize itself. There's 18 stocks that have a lot of cash, a lot of runway, meaning that cash is going to stick around a long time, and have significant revenues. So 18 here, and obviously we're all over those. We're looking at those very closely. And today, 3 of the 18 had very nice moves. We think selectively some of the healthcare stocks are overdone. As I mentioned, United Healthcare, that is a fallen angel. I would buy. I like that one based on the insiders buying the stock, and likely I would be surprised with those insiders buying if there's any criminal issues to worry about. Staples are really cheap. When you buy staples is when they're really cheap. You don't buy them when they're really expensive after they've already run. These are high quality companies. They're down. It's been brutal for this group. They pay nice dividend yields. You want to buy them. This is also kind of a hedge in the portfolio. Buy them when they're cheap, and they're trades. So you're not going to get a big run out of them at this point, but they're nice. They're nice cash substitutes. So I can see it outperforming cash by 2 or 3x what cash is currently doing. And if we get lucky, something happens bad, then those stocks maybe move a lot higher. Bank stocks are attractive. They haven't pulled back much, but we like them. The fundamentals are good for the banks. They had really good quarters. Autonomous driving, there's a couple ways of playing that, and you're going to see it all over the news probably later this month and into July. All these cars on the road down in Austin, Texas, where both companies, Google and Tesla are going to be testing their cars in Austin, Texas. But nice way of playing this is Mobileye. We like Mobileye. Intel owns 80% of Mobileye, so Intel's lagged a lot. Stock's down below 20. That could be acquired by somebody for $30 a share. We think Intel will slowly get better. So around below 20, we think that's a reasonable buy, and they've got the benefit of having that Mobileye exposure. And then consumer cyclicals, lots of things happening here. If interest rates come down, we like the housing related stocks there. We think they will come down. I think what's happening in housing is really overdone by the Fed. So we think that the quantitative tightening will go away, and that spread between the treasuries and the agency debt will narrow, and interest rates will come down, mortgages will come down. So we like the cyclical stocks. There's a lot to do there. A lot of them are down because of the tariffs. So they got hit because of the tariff scare. We think that's an opportunity to buy it. We think that the tariffs are manageable, so it's not as a big an issue as people think. So on that note, the specialty apparel area, I tell you, I really haven't looked at this group in really hard in a long, long time. And I know Abercrombie and Fitch has been a big winner. It went from 13 to as high. It went to 196 last year. 196, 13 to 196. That's a massive move. I mean, that is incredible. Okay, the stock's back down to roughly $78. So it's had an equally incredible decline, right? So up big, down big. The fundamentals there are good. Hollister is their big winner. Hollister's comps are growing at over 20%. So you can see here, Abercrombie, the total comps are up 4, but the real winner is the Hollister line. The stock sells at 7.5 times. So this is kind of our case study. I think I like Abercrombie. We added it to the portfolios recently. I like this stock. I think there's upside. There's not the margin improvement like the other companies have. So the margins went from basically very low, almost nil, 2.4%, to 15% now on the margins. So we think that over time maybe these margins come down a little bit, but Abercrombie could have another run. Gap, we like Gap a lot. So we think Gap is much earlier in its turn, trades at 9.7 times, higher quality company, nice yield. The quarter was good, 2% comps in the quarter, driven by Gap stores, their main division, and Old Navy. Okay, the operating margins are half what they are at Abercrombie & Fitch. We think the operating margins go up over time. The stock came down quite a bit. Let me show you this. The stock came down from roughly $28 down to $22 on the report. Okay, what they said on the report was that they believe that that the terrorists will cost them as much as $150 million. So that's about 10% hit to the bottom line. So the stock reacted to it. We don't think it's going to cost them that much, and they could pass that along to their customers really easily. Gap's products are really attractively priced. The customer wouldn't notice a 10% increase. There's no way. But anyhow, this we're back to a really interesting point for the stock. We added to it on Monday. American Eagle. Okay, American Eagle we've been watching. They missed. They missed their quarter. Negative 2% comp. The merchandise wasn't right. It is in a turnaround phase as well. It's really, if you look at the chart, it's really, really early for the stock to be turned around. It went from 22 down to basically $11, $10. We want to buy it below 10 is what our goal is. Buy it below 10. And we think that technically there's a lot of buying pressure as this thing turns around again. We think it could go back to 22 over time. The company is aggressively buying their stock back. And so we think that the merchandise looks much better. I was in the stores. I liked it. I think this is an interesting stock as well. And then Urban Outfitters had a really strong quarter. This reminds me of Abercrombie & Fitch a lot. Very strong quarter, good sales, good margins, good expense control. This used to be a high flyer, and the stock's been moving. So we'd like to see this pull back if we would buy it, before we would buy it. But this fits the group. The whole group's kind of in a turnaround phase. Our favorite is probably Gap stores. I like Abercrombie & Fitch as well. I'm looking at American Eagle, buying it on the cheap. And if Urban would pull back, we'd probably buy some of that. So this is a different sector, right? It's not technology, and it's consumer, and it's these, the teen consumer, some teen consumer in the mix there. So they can be fickle, but they've got good discretionary income, and the merchandise looks good at all these companies. I think the merchandise looks good. And we're going to have a cyclical pickup, I think, as we go in the back half of the year and in the next year. And the terrorists were the scare that is allowing us to buy some of these at really attractive valuations. Now, just remember, the technicals are positive. They could turn, but they're positive. The economy looks really strong this quarter, surprisingly strong. Tax cuts hit in the second half, additional tax cuts. The budget needs to be fixed to make sure the house doesn't collapse with the bond market. So far, the bond market's been well contained. So, kind of the momentum's to the upside. We have probably a good, number of weeks before we get into August, where we have some seasonal issues in August and September and October. So we have some runway here, a little bit of runway in a highly valued market. But we think that there's some good rotation to occur. Now, if you have any questions with anything we do, ping me. come to my website, Patrick Adams CFA, sign up for a hard copy of Market in a Minute. There's a lot of information on that hard copy. If you ever need any help with your investments, if you're a financial advisor or individual, just reach out to us. We're happy to do a conference call to discuss what we do. Take care.